we'll look at a few what I will call special issues under Section 954. And that has primarily to do with a few rules in the foreign personal holding company income area, and a couple of things in the foreign-based company sales area. We've already, from our discussion last week, I think sufficiently beaten upon foreign-based company services income. So unless you wish to bring it up, we'll leave it in the grave at the moment. Now, I've shown this as a tiered thing with U.S. company owning CFC-1, which owns CFC-2. But it does not have to be that way. It could be that they are brother-sister companies. But this allows me to cover several things in the discussion. So I'm showing the diagram this way. Now, in this case, let's first start out and say that both of these subsidiaries are in country A. Both same country of incorporation. And let's further say that CFC2 has an active business and conducts that with assets and activities primarily in country A. Now we want to, in order to try to demonstrate the reason behind this, let's pretend for a moment that the box has been checked for CFC2 and it's treated as a disregarded entity. Box has been checked, it's treated as a disregarded entity. So the question becomes, will CFC1 have any subpart F income, or let's say, is CFC1 likely to have any subpart F income from this active business which is being conducted within its country of incorporation? Yeah, probably not. Yeah, I mean, certainly it's possible, but probably not if we're talking about active business income inside the country of incorporation. Now, let's now go back to the other alternative, which is that CFC2 is not a disregarded entity, and it is being treated as a corporation. And let's say that there are the following transactions occurring between CFC1 and CFC2. So first of all, of course, we know that there's shares, and there's the possibility that CFC2 might make a dividend distribution. That's one possibility. Second possibility, CFC1, when it set up CFC2, or after it acquired, maybe it loaned money to CFC2. So we might have interest payments going from here to here. Now, let's just look at dividends and interest for a moment. Are dividends and interest included in the basic definition of foreign personal holding company income? I see a couple of nods of the head. Okay, that's encouraging. Yes. One of the basic, line items of foreign-based company, I'm sorry, foreign personal holding company income in 954C is dividends, interest, rents, royalties, annuities, and so on. So on the surface, the dividend and interest are very clearly foreign personal holding company income. But let's think about this. We said that if CFC2 were a disregarded entity, we said there would not be any subpart F income, probably. And if, because of business or tax, local tax, or other legal reasons, CFC1 decided to conduct this business through a subsidiary, CFC2, instead of operating directly, let's say, as a division of CFC1, why should CFC1 and its shareholder get a worse answer because there's dividends and interest being paid from one company to the other, when if the operations had been conducted directly by CFC1, there would have been no subpart F income. So there's some logic in having a rule that says that if the payer of the dividends and interest is a related company, in this case over 50%, and if it conducts an active business in the same country of incorporation, and both companies are incorporated in the same country, and if this company is not earning subpart F income, CFC2, then we really need an exception to the general rule to not penalize CFC1 and, of course, the U.S. shareholder creating foreign personal holding company income. We don't want, in this situation, to create foreign personal holding company income. It would be economically wrong. We would be not giving the taxpayer the freedom to, in a sense, structure his activities the way he wants from good legal and business concerns. So we're trying to get to the same answer, and that's what 954C3 does. For dividends and interest, it has those criteria and says, okay, those dividend and interest items will not be foreign personal holding company income if these conditions are met. There's no tax avoidance motive in setting up CFC2 if the activities, if conducted directly by CFC1, would not have been subpart F income. Now, in order to not unduly kill the clock, so to speak, let me say that while the rule is a little bit different, you have the same rule for royalties and rentals. So if CFC1 licenses an intangible for use in country A by CFC2, then that's okay as well. Now notice the location of use is what's important in a rental or a royalty situation. So actually in that case, this could be incorporated in country B, but as long as the asset is used in country A, there's clearly no tax avoidance motive, and we say that's okay. Now, one additional comment here CFC1 could, of course, choose not to loan money. They could contribute all of the cash that's needed by CFC2. They could have done that by just putting in more equity. But is that very efficient from the standpoint of taxation down here at the CFC2 level? Okay, no, it's not, because there's no deduction for dividends. There is a deduction for interest. So notice that this rule, which allows, which avoids the subpart F problem, which avoids foreign personal holding company income, this mechanism allows for planning that effectively will reduce the level of taxes in country A imposed on CFC2, because it's allowing interest, rentals, and royalty that are normally deductible items. It's allowing those items without the creation of a subpart F problem that'll cause income up here at the U.S. level. So this rule, in a sense, is saying it's okay to try to structure your activities to reduce foreign tax, as long as you stay within these rules. Now, before the break, we'll do one more thing, and that is to look at Section 954C6. Section 954C6 does pretty much the same thing as 954C3, except that it's so broad that, in a sense, you can drive a truck through it. And in that case, for example, this could be country B, and country A loans money to CFC2, and the interest or royalties or rentals will not be subpart F income, no matter where the property is used, the intangible or the tangible property subject to the royalty or rental. The only requirement is that, or the only requirements are, number one, that the CFC2 is related, over 50% common ownership. And then secondly, that the payment of interest or royalties or interest, royalties, or rentals not reduce subpart F income that CFC2 might be earning. Now, this one, because there's no requirement that they be in the same country of incorporation or property used in the same country of incorporation, because of that, this is a very broad acknowledgement that, gee, it's okay to do all the planning you want that will reduce foreign taxes on CFC2. Because typically, an interest or royalty especially, and certainly rental to some extent, will be fully deductible against the taxable income of CFC2. But the withholding tax coming out of, in this case, country B, will probably be, percentage-wise, either much less or even zero. So structuring legitimate interest, royalties, and rentals can go a long way toward reducing the overall level of foreign tax. So this 954C6 really is the U.S. government saying, hey, go ahead, do all the planning you want, it's okay. (954C6), if I remember correctly, came in 2004. It was originally supposed to sunset a few years ago and was then supposed to sunset at the end of 2009. And in the recent agreement between the Republicans and President Obama, it was again given another 2 years of life. So it's supposed to sunset at the end of 2011. Because foreign tax, excess foreign tax credits are a big problem for companies, there will be a great deal of lobbying for this to continue. This acknowledgement that, yes, it's okay to do all the planning you want to try to avoid and lower your effective U.S. tax, foreign tax rate in your countries of operation. So there should be a lot of pressure for this to again be extended or perhaps made permanent. Yes, Glenn.
So you want to do this where CFC2 is in a lower tax rate country than CFC1 generally, because this is just how the U.S. looks at this. CFC2 is still going to pay the same amount of local tax as their tax form requires.
Well, let me restate what I think you're saying. Let's assume, whether CFC2 is in a high tax country or whether CFC2, whether country B is high tax or medium tax. Let's assume it's not low tax. The more income that CFC2 recognizes from its operations, then there's going to be more tax. But if we can artificially lower the taxable income by structuring legitimate, but still artificial mechanisms, which are to loan them money instead of investing as equity, or to, instead of putting in more equity and letting them buy their equipment and then depreciate the cost of the equipment. Let's say the cost of the equipment is 100. If we have CFC1, which is, let's say, in a low tax country, own the equipment, buy it for 100, and then lease it to CFC2, but because, of course, a lessor is reasonably allowed a margin of profit, maybe over the life of that equipment, there's rental payments which total 150 instead of only the 100 of depreciation that it would be if CFC2 bought the equipment.
Okay, so CFC2, country B, would have to be recognizing the reduced income, the shift of income from country B to country
Oh, absolutely, yeah. In other words, we're creating deductible items in CFC2 which are the result of, something that's real, but because we're related parties, we can structure whatever we want, and as long as we do it with some substance behind it, we can choose again whether CFC2 buys the machine for 100, or whether CFC1 buys it at the same price, but then leases it to CFC2 and earns a normal arm's length commission, or not commission, an arm's length rental fee, which in total over the life of the machine can easily be 150. So through those mechanisms, we've effectively reduced the tax base in CFC2. CFC2 is still doing the same business, earning the same gross income and the same operating expenses, but now it's got some payments which are deductible going off to related parties that reduce its tax base. And 954C3 and C6 are saying this is okay. Go ahead and do planning that reduces your foreign tax. And does that make sense? Well, actually it does, because remember, there's a foreign tax credit mechanism. $1 more foreign tax, ignoring excess foreign tax credits, $1 more foreign tax reduces how much tax that taxpayer ultimately will owe the U.S. government. So it's to the U.S. government's benefit to allow companies to do reasonable tax planning to minimize their foreign tax. Now, we'll see when we talk in a few minutes after the break that there's another situation where it's the exact opposite. Save foreign tax, but then you get hammered under Subpart F. So there's a lack of consistency. The next item is the personal service contract category of foreign personal holding company income. Now, you might scratch your head and say, gee, that doesn't sound like foreign personal holding company income. Income from a personal service contract. Okay, so first of all, what is it and why is it there? If you have a CFC, and if there's a 25% or greater individual owner, and that individual has well, not necessarily that individual, but if there's service contracts, yes, I'm sorry, it does, it has to be the individual. There are service contracts that designate that only that person can perform the services, or that the client has the right to say who will perform the services. Then you have this kind of situation, which is personal service contract, foreign personal holding income. Now, what's behind this? Long before there was a Subpart F, there was something called the personal holding company, which still exists, and the foreign personal holding company, which, let's say, went to the grave in 2004. And in both those personal holding company and foreign personal holding company, there was a category which was exactly this, personal service contracts. And what was the reason for it? Well, if we go back many years when individual tax rates on ordinary income were very, very high, and capital gains were very, very low relative to ordinary income, you had a very large incentive for an individual to, in a sense, perform his services through a corporation rather than personally. And then when he had accumulated all this income inside the corporation, he would liquidate the corporation and have capital gain. Or he would sell the shares of the corporation and have capital gain. So this was, good creative tax planning. Well, in these personal holding company regime, which is still around, but which focuses on the domestic side. And now in Subpart F for a CFC, we still have this category of income which will be treated as one category of foreign personal holding company income, and therefore Subpart F income. So the reason not allow an individual to, in a sense, place his income from services inside a corporation. And that's why there's this connection that the service contract or the client has the right to designate that individual as the person who will perform the services. If there's no right, or it's not in the contract that specifically that individual will perform the services, then of course any employee of the CFC could do this, and it's not treated as being this mechanism to just put your own income from labor into corporate form. The reason it's in the foreign personal holding company rules today is that when the foreign personal holding company rules were eliminated in 2004, and they also at that time made crystal clear that the personal holding company rules were only applicable to domestic corporations, they said, gee, there's still this issue that we need to deal with, therefore let's just plop it into the foreign personal holding company provision, and that's why it's there. So it doesn't feel like it should be there, but that's where it was put.